Welcome to the Stock Market Palantir. Today we are going to talk about FOSL. So we're focusing today on Fossil Group Inc. and the dramatic financial maneuvers they pulled off back in November 2025. This wasn't just a simple refinancing. They used a really sophisticated mechanism, the UK Part 26A restructuring plan, and then had it recognized here in the US with Chapter 15. The real question for us today, the core of our debate, is what did this all actually achieve? I mean, did this impressive legal feat fundamentally save Fossil for the long term by kicking that 2026 debt maturity down the road? Or did it just turn the company into this impaired, unsustainable zombie entity that's now saddled with incredibly expensive debt and, crippling structural issues? My view is that this was a necessary, even successful strategic move. It bought management the precious time they desperately needed to turn the ship around.
I see why you'd think that. I do, especially when the alternative was almost certainly a Chapter 11 filing. But I come at this from a completely different angle. I agree the legal strategy was masterful. They absolutely dodged an immediate bullet. The problem is, I think they exchanged a fast, clean death for what looks like a very slow, very expensive purgatory. I believe the company that came out the other side is just structurally broken for anyone holding the equity. The price of survival was this new, high-cost, secured debt structure that, when you combine it with the insane leverage, it just puts a hard cap on any realistic long-term upside for the stock. And if you look at the numbers, the CCC plus credit rating, the constant cash burn, it just screams corporate zombie. It's just enough cash to service the debt, keep the lights on, but absolutely nothing left over to actually invest in growth and fight the, frankly, secular decay of their whole business.
Okay, let's dig into that, because I think the strategic value here is being understated. The existential threat, the thing that would have killed them, was that 2026 maturity wall. Without this restructuring, common equity would have been wiped out, full stop. So the value they gained is a liquidity runway all the way to 2029. And to get there, they used that UK Part 26A cross-class cram-down, which, to put it simply, it's a powerful legal tool that let them force the deal on creditors who didn't like it. That maneuver was the key. And they didn't just push out the debt. They also got their hands on $32.5 million in incremental new money. That's crucial operational oxygen. And look, management isn't just sitting on their hands. The Q3 2025 data shows a 7.5% cut in SG&A expenses, and this is the big one for me, a 26% reduction in inventory. That's a huge drop to $166.8 million. These are real disciplined actions to generate cash. They're using the time wisely.
I grant you the competence on the cost-cutting. I do. But you can't cut your way out of a failing business model. And avoiding immediate death is not the same thing as long-term health. The equity holders paid a colossal price for this reprieve. We have to focus on the structure they created. They swapped their old unsecured 7% notes for new, much more expensive secured debt. We're talking about $1.625 million in first-out secured notes with just a punishing 9.5% coupon. So not only did the interest rate jump, which tells you how risky the market thinks they are, but the debt is now secured. For anyone listening, that means company assets are now pledged to these new note holders. This one move just drastically shoves common shareholders down the pecking order. The financials are just screaming distress. You're looking at nearly 10 times adjusted leverage and a $65 million free operating cash flow deficit. So they are structurally burning cash just to operate, and that's before the huge interest payments. The financial fix, as complex as it is just masking the real problem. Revenue dropped 6.1%. They are still 83.6% reliant on traditional watches in a market that has clearly moved on to smart wearables. They are shrinking a business that is, I think, structurally obsolete.
That's a fair critique of the cost, but the 9.5% coupon, the secured nature, that was simply the market price for a company staring down a liquidity crisis. The alternative was liquidation. So let's talk about that subordination, because it ties directly into the value of the time they bought.
Exactly. Let's talk about the weight of this new capital structure. Moving to secured debt shifts all the risk onto the equity holders. When we say first out or second out, we're talking about the inter-creditor agreement. That's the document that says who gets paid first when, or if, this company liquidates. And equity holders, they are at the absolute bottom of that waterfall, hoping for scraps after the ABL facility the first out notes and the second out notes get paid in full. The stability you're talking about, that runway to 2029, it's totally conditional. It depends on management pulling off a miracle turnaround. So I'm sorry, but that S&P upgrade from selective default to CCC+, it's just window dressing. CCC+ is deep, deep junk territory, and the negative outlook specifically says the high insolvency risk is still there.
I acknowledge the risk, absolutely. But the rating is about credit risk, not necessarily the potential for equity volatility. What the legal structure provides is certainty. It's a foundation management can actually build on. The Chapter 15 recognition here ensures this whole new debt architecture is enforceable everywhere. Before this, they were paralyzed by that 2026 maturity wall. Any operational fix was pointless because the clock was about to run out. Now, that foundation is set. The focus can shift entirely to execution, and they have 3 years to prove they can do it. In retail, that's a significant window of time. The time is the real asset here. But time is a cruel mistress when you have that much debt and you're fighting a shrinking market. And that brings me to the second major structural problem you have to address, the massive dilution and that warrant overhang. The fully diluted share count is ballooning to something like 65, maybe 70 million shares. That dilution is the second major blow to anyone who held this stock before the deal.
Okay, I absolutely acknowledge the dilution, but let's frame it correctly. It was a transaction cost, the unavoidable price of getting the deal done. That dilution was necessary to get the supporting note holders, we're talking about HG Vora, Nantahala, to not only sign off on the deal, but to also backstop that $32.5 million in new money. Those funds got 3 million warrants with a 50-cent strike price, which are deeply in the money. This was the mechanism they had to use to avoid Chapter 11, which would have meant a 100% loss for equity. Dilution in this context really was survival. I'm just not convinced by that argument because what that structure does is create a permanent structural ceiling on the stock. You're right, those warrants are deep in the money. So now, what's the incentive for those institutional holders? It's to exercise those warrants and sell the shares into any rally to lock in their profit. This isn't a one-time thing, it's a chronic, perpetual supply overhang. Every time the stock gets any momentum, these institutions have a deep pool of subsidized shares they can just dump on the market. It makes a sustained, multi-bagger return for retail shareholders incredibly difficult. The mechanism is designed to cap appreciation. And let's not forget the 2.5 million pre-funded warrants. For the listener, these are basically instruments that give institutions an equity-like position without them having to immediately hold common stock. And that's critical because it lets them skirt the beneficial ownership reporting rules. It obscures the true depth of their positioning. That lack of transparency is just poison for market confidence.
The opacity of institutional positioning, while yes, frustrating, is just a feature of how sophisticated capital works in these distressed situations. But that dynamic, the huge short interest that's created by all this, that leads us right into the market microstructure. And that introduces a very volatile upside opportunity that has to be part of this conversation. And when I look at that microstructure, I see institutional bearishness, not opportunity. I see deep-seated skepticism. I mean, look at the data. The off-exchange short volume ratio is at an extraordinary 69.65%. That is stealth selling in dark pools. Sophisticated funds are actively and aggressively shorting this company, and they're hiding the true depth of that bearish sentiment from the public market. This is institutional capital betting against the turnaround. That is a compelling point, I'll give you that. But you have to consider the flip side of that high short position. I'm looking at the days to cover ratio, which is at an extreme 14.02. To put that in plain terms for everyone, that ratio is a coiled spring. It means if management delivers any positive surprise, a better than expected earnings report, a new strategic announcement, the short sellers would be mathematically forced to buy shares aggressively for 2 full weeks just to close their positions. That technical constraint creates the potential for a high-stakes, parabolic price spike, a classic squeeze mechanic. The stock, while fundamentally challenged, is now a vehicle for massive volatility speculation.
Okay, I grant you the volatility potential, but volatility is not a business strategy. And that brings us right back to the core operational problem that this whole restructuring just papered over for a little while.
Well, let's circle back to those operational metrics because they show management is actively fighting that decline. The 26% inventory reduction is critical. In retail, controlling your inventory is the single most important thing for generating cash and managing working capital. It's an existential necessity for a turnaround. And the expense discipline, the lower SG&A, it proves management is aligning costs with their smaller revenue base. They are optimizing the business they have today so they can survive long enough to even try to grow tomorrow.
I agree, they're optimizing for survival, but that is the very definition of a zombie. They are shrinking their way to a fragile stability, not growing their way to prosperity. That 10 times leverage ratio becomes completely unsustainable if revenue keeps falling. You're celebrating a 7.1% drop in constant currency revenue like it's a minor hiccup. It's proof that the market for their core product, fashionable analog watches, is disappearing. They don't have the R&D budget or the tech expertise to compete with Apple or Garmin. The entire fashion segment they live in is being squeezed from the luxury end and the tech-forward end. They can cut all they want, but if the product isn't relevant, they're just delaying the inevitable.
But the time gained until 2029 allows them to pivot that product mix, to prove they can find new relevance in accessories, move beyond just timepieces. That's the opportunity this restructuring secured. They have a known brand, they have distribution, they just needed to stay solvent long enough to use them.
And at the same time, they burdened themselves with leverage that will suck up any cash they generate, and they created a dilution overhang that will cap shareholder returns. The very mechanism of their survival severely limits their ability to succeed. And we can't ignore the NASDAQ delisting threat. Trading below $1 for too long forces a reverse split, which often just triggers more volatility and liquidity problems.
That's a critical point to end on, I think. The financial maneuvering was brilliant. It prevented an equity wipeout, and it bought them valuable time. The structure is complex, sure, but it has created a defined path for management to attempt a revival, and it's supported by real, measurable operational improvements in cost and inventory. The runway is there.
While the legal team definitely earned their fees, the company that's left is heavily debt-laden, it's structurally impaired by dilution that caps the upside, and it's still fighting a losing war against technological obsolescence in its main market. FOSL is and remains a highly speculative trade. Investors have to weigh that extreme technical volatility against the severe structural dilution and the very deep operational risk.
Ultimately, you're right. This complex structure requires investors to weigh that extreme volatility setup, that 14 days to cover squeeze potential against the deep operational challenges and the severe structural limits imposed on any long-term shareholder return. It's a fascinating high-stakes case study. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.